Hello and welcome to another BetaKit Live. I'm your host, Douglas Saltis, editor-in-chief of BetaKit, and this time we're going to get right into it. Because at this point, no tech company should be surprised by the state of the public and private markets. No matter how you choose to define it, is it a downturn? Is it a recession? Is it a bubble? Is it like 2001? Is it like 2008? Times are tough for most startups. The real question isn't how bad, it's how should smart companies respond? So today, our conversation is going to be focused on how startups can use data to survive, identifying the metrics that your company needs to keep a close eye on, and how to take action based upon what the metrics are telling you. I know absolutely nothing about this. Thankfully, we've put together an amazing panel of guests to explain this important subject to you. So I'm going to start off by introducing them, and then we're going to dig right into the conversation. But I'd like to note that I have some questions to ask, but you can ask questions too. So whether you're on Facebook or Twitter, throw those out in the chat. They'll be sent to me and we'll make sure that your questions get answered as well. So to start off with our guests, we have one, Peter Fishman. He is the CEO and co-founder of Mozart Data. We're so happy that they're working with us to produce this conversation today. We have Ethan Ruby, partner of analytics at Craft Ventures, who's also an investor in Mozart Data. And then we have Katy Yam. She's the partner at Real Ventures and the general manager of Founder Fuel. And I'm looking very much forward to finally meeting her in person in a few days at Startup Fest. Thank you all for being here and donating some of your time to talk about something that I know all of your portfolio companies and probably some of your clients are thinking about daily right now. Okay, so let's get this kicked off. I was pretty dramatic in my opening because I'm a liberal arts major and I like doing stuff like that. But we should kind of level set on like what the state of play is, what's currently happening. And I think probably, Ethan, I want to get you in here because when we were doing our prep call for this, you kind of ran through a bunch of the macro conditions that are just defining the current circumstance of the midway point of 2022. So you want to just take us through that and then we can start kind of like piece by piece, teasing out what startups should be dealing with or paying the most attention to?
Yeah, absolutely. Happy to kick it off. Excited to be here, Doug. Look, I think at a very simple level, we are at the end of a business cycle, right? Like, things have been great for the past 12 years, and now things aren't so great. This is kind of the natural state on the world. On the other hand, things are very unnatural, right? And we kind of feel like we hit this one at the brick wall. I think kind of the natural end of the business cycle really would have been at the beginning of COVID, right? There was this kind of like this massive dislocation in the economy. But governments responded through a tremendous amount of spending and stimulus, which really kept the good times going for quite a while. Right? There was a ton of money in the economy. We saw big public investors like the Tigers and the Coatue of the world come down out of the public markets and start investing in the private markets. We saw massive markups and a ton of competition among investors for the hottest, fastest growing deals during that period. So like the good times were really rolling and really rolling fast, through 2021 and 2022. However, as is kind of inevitable when you have that much money in the economy, inflation started to spike. We all know that. And therefore interest rates went up. And when interest rates go up, stocks have to go down. It's just kind of one of those iron laws of the universe. And when that happens, growth stocks get hit the hardest. And what are the fastest growing public stocks out there? They tend to be tech stocks. And where do growth stage investors take their cues from? They take their cues from the public market. So the growth, the private growth markets, start to temper. And where do early stage investors take their cues from? They take them from the growth stage investors. So this kind of like trickles all the way down, into earlier stage startups. And at the same time, because we kind of hit the wall so hard on this one, a lot of those funds that were writing, a lot of the big checks, the Tigers of the world, really became risk off and started slowing down their investment. So basically, you have all these things coming together to just create a slowdown in the funding environment. It's not existential to tech, but it's definitely going to be a slower period.
Yeah, like a general business slowdown compounded by Tiger leaving the market and maybe some whiplash related to that. Like if we were doing this live stream this time last year, Tiger Global would have tried to invest during the live stream. And now we can't get them to return our calls. So I think what you're saying very much makes sense. But you noted kind of the trickle down component, and that's probably a great place to get Katy in, because in your role at Real, you're kind of handling two important components. You're doing the founder fuel, so like incubation and acceleration, and kind of the early stage investment. As is this downturn evenly distributed across kind of maybe the public markets and the high end scale ups all the way down to the early stage, or are you seeing something different at that level?
So I think that there's definitely what Ethan was talking about with regards to like the growth stage companies and even heading into the Series A. But scrappy startups that are starting at the genesis. So, 2, 3 founders have an idea, there's a problem they want to solve. They're kind of working towards their MVP. They're not exceptionally capital intensive at this point in time. So, for that period of time, that first 6 months to 8 months, 8, 9 months, a year, when they're just, really scrappy, figuring things out, what's happening in the capital markets right now and whether or not the capital is there isn't really going to affect them. It's really when they've kind of got an idea of an MVP, or they actually need to build something more substantial, do a POC. That's when they have to turn to investors and take a look to see. And that's where I hope, if they start now or they're in the genesis of that, by the end of Q4, hopefully Q1, some of the uncertainty that we're seeing in the market, right, will stabilize. People will get a better feel of what's happening, inflation, interest rates, some of the bottoming out and nervousness will. And I think a lot of it is like the balancing of portfolios right now. So a lot of people in the funds are trying to, over-index because obviously the stock market's kind of tanked. So a little less, investing into the VC space right now. So I think pre-seed and everything like acceleration, like that'll probably be unscathed for now, just how scrappy it is. And I often the startups I'm saying, accelerator programs that are venture backed, so like Founder Fuel and or Techstars or Y Combinator and 500 startups, anyone that's actually putting money and capital in, or the other accelerators in there, it's a great time to head towards those. Initial checks, get the ball moving, get those MVPs out. So I think it's not evenly distributed. Coming to what we were discussing earlier, I think in the incubations and acceleration, we're okay for now.
Okay, so if you are just looking for capital to fuel your ramen budget and an MVP, you're doing okay. But if you maybe did 3 safes last year, you might be seeing the oncoming car crash on the freeway, and you might be looking to kind of avoid it or at least slow down a bit. Peter, let's get you in here because like there's a lot of interesting perspectives that you have and are representing here. One, as someone leading a company, right beside what your lead investor. So I'm very excited to see how that goes. But then also like you have customers in this space that are probably using your service to get like a real-time pulse check on what's going on with their business related to the broader downturn. So how are you seeing kind of either from an operator perspective or just broadly through Mozart's perspective, how are you kind of seeing this moment in time?
Sure. Well, there are different lenses, right? And on the one hand, I have the operator lens. I'm running a startup. And on the other hand, I am running a startup that assists other startups, particularly with their data and their data analytics needs, which is very relevant to the conversation at hand. Kind of sitting here, I feel a little outnumbered. We have some investors, and then we have me, the operator. And when you hear investors talk about kind of this downturn, it's all very rational. It's responding to signals that they're seeing in the world, and they're responding rather quickly. From my seat as an operator, it sometimes feels kind of, you described it as whiplash. If you think sort of about a business cycle, it's very much like a sine curve that gradually goes up and down. In practice, my experience has been, go, 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 grow, 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 grow. And then suddenly, you see a big red light and you have to really slam on the brakes and sort of react to the big red light. So my experience sort of hearing it as the co-founder of a startup is very different than my experience as sort of a data leader and the work that we do at Mozart Data to assist teams in gathering the appropriate data. I think the biggest takeaway for me is that, this very rational reaction and these sort of measures that Ethan and Katy have started to talk about sort of come with sort of higher expectations. If you think about kind of the world a year ago, versus today, I think the biggest thing as an operator is that there's much higher expectations for the same level of sort of achievement on the fundraising side or the ability to raise funds side.
Yeah, higher and maybe possibly like more grounded to reality, given this. But it's interesting because we're kind of making we're making fun of this. I think we're generally lighthearted people, but there's a real human cost to this, as we've seen on both sides of the border in Canada and the U.S. Like significant layoffs as part of like kind of hitting that red light and having to put the brakes on. There's been numerous reports of at large scale fan companies of employees being laid off before their hiring start date and things like that. So like if there's anything that we can do today to get companies to a point where maybe they're making those course corrections before it's a component of slamming on the brakes, I think that's kind of what we're here for. Katie, you want to jump in on that?
Yeah, I would love to just comment on, I think as an, so before being a VC, I was an operator for like 20 some years. And I think there's a VC treadmill style operator, and then there's like there's many types of operators in the in the ecosystem of entrepreneurial land, and then the startup land has its own set of rules. And I think right now we're seeing more come to terms of like, okay, so funding that infinite growth and hiring before the need comes and before the revenues arrive, which is kind of what we see in the last couple of years. I think there's a coming to balance mode of like, okay, so what is actually an organic growth model? How much do you need to hire right now? And instead of the landscape being seen much further out, when you start to hire almost a year, you hire a CRO like way before you start to have any significant ARR or MRR metrics. Well, maybe that hire, we're not going to fuel that as quickly as now. So I think it's just a readjustment of what that horizon looks like on the operating side of it. And I do think that there's kind of a topping off as to like what that VC treadmill will, at the speed in which we force our founders to run. I think there is a little slowing down and coming onto more of a typical entrepreneurial journey, which is, what are your revenues? What are your clients? Your LTV over CAC,
Yes.
like all these kind of statistic, like real numbers of like what a business growth would look like. Not going to a bank loan, not that old, like that kind of old school metric, but somewhere in between. And that's what I think the pivot we're going to see. So a good business will always get funded, like regardless of the downturn or not. Like solid businesses, as we know in the last downturns, some of the best startups and the best companies solving the biggest problems like Airbnb and Uber, et cetera, like those emerged out of crisis moments. So it's not possible. So it's not all doom and gloom. But the solid metrics of user growth, revenue growth, these things are definitely things that maybe we discounted a little bit in the last couple of years.
Yeah, totally. I think we're all here, and I think our audience here, just seeing more people join in on the Twitter and the Facebook streams, are here because they want to do something about it, which is a great place to start, right? Nothing's going to change unless you take that kind of first step. But you said the kind of magic word. I want to get this kind of like last point in before we go to our second segment and like actually start looking through what those numbers or those frameworks look like. You said the pivot word, and Peter said something really interesting on our prep call last week that was a little counterintuitive to how I normally see it. So I want to really dig into it more. You were saying that like operators pivot teams towards efficiency, which makes sense to me, but by measuring the channels that work the least well and diverting resources from them. And that seems counter to, what we normally hear, or maybe what Katie was speaking to, where it's usually optimizing for the channels that are expected to work the best. And you were kind of coming at that from a different lens. So do you just want to shine a little bit more of a light on that before we start digging into what those numbers and milestones look like?
Sure. I mean, I think that the description is pretty self-explanatory. There's a couple of ways to get better. You can optimize and improve the ratios of the channels that are working, or you can shed or diminish the channels that aren't working. And either way, you sort of improve your weighted average. So a lot of times people really focus on measuring the subset of things that are working. And, we sort of take the approach of try to measure everything that you're investing in, whether that's, R&D, or whether that's your marketing budget, or whether that's, channel A or B or C. All of those things should get measured. If you're investing in it, that which gets measured improves, right? So that's Pearson's law, and that's sort of one of the core beliefs of our company, which is measure all of these channels. And invest in the channels that are working, optimize the channels that are working. I certainly agree with that point, but also I think the harder thing, because people have this sort of inertia as default, the harder thing is cut the channels that aren't working. Be honest with
Mm.
yourself. And a great way to be honest with yourself is to measure it.
Yeah, you are not going to feel growth right now and hope. Okay, so let's dig into this. Let's kind of this next section is going to be entirely about kind of like providing a framework and a structure for startups who are like, this sounds really relevant to where my company is right now. I would like to learn more. But before we get to kind of some of the frameworks that our VCs have, Katy, I want to go back to you because you were talking about like in terms of getting prepared. There is what you're looking to prepare your business to do or be able to do to survive. But then there is also the contingency planning for if that's not successful. And you were mentioning a bit of a checklist that you're working through with founders right now in case things aren't possible. So can you just talk through what that checklist is and some of the components of it?
Sure. So I'm definitely, for those who know me, I'm definitely an optimist. I want them to raise the rounds and I want them to make it through definitely what's coming. But the best way to do that is making sure that you know where your emergency supplies are and everything. So I have kind of a checklist. It's kind of like the worst case scenario checklist. So we understand, if you can't raise, what's the bottom price that you could ask to have an acquisition or a sell price? Like what's the risk? And pretty much like how do you land the plane as a founder and not crash the plane? It's better to walk away with an acquisition that may be for a loss, but at least you've kind of landed it. And we love second and third time founders as well, so there's a lot of learnings in there. So the initial checklist is definitely, I always ask like, what's the debt situation like? Especially of all the debt that the debt load, how much of that has personal liabilities attached to that, because there are certain things that founders don't realize. There are certain things you cannot walk away from, even if you go bankrupt as an entrepreneur. You can't walk away. Well, in Canada, I don't know about the US, but in Canada, you can't walk away from any tax liability. You can't walk away from any kind of outstanding wages. You can't walk away from anything that of debt that you have personal liability. So oftentimes I have founders kind of assess through like, what is all that load? And then we kind of have a minimum sale price, at least at that floor, so that you can walk away from the wreck and not have torched yourself in it. Because the other consequence is that if you're not thinking about that, your personal bankruptcy is 7 years. So that will affect you buying a house, if you want to get married and all that kind of stuff and have credit cards. Like, it's not the end of the world, but it is a reality that like some people think they can close their business and just walk away. That is not the case. So bringing that floor out, just talking through what insolvency looks like and what you have to show as preparedness and how the trickle effect on debt works. And those things are just the basics. And then understanding what you have on IP, what you have on your talent. Like, is it an acqui-hire that you're up for? Or is there value in your IP and stuff? And then just getting a pulse and having the founders kind of reassess all that and having another conversation to set the floor makes it so that when you go swinging for the fences on actually an acquisition or an LOI, you already know what to look for. So some companies, unfortunately, right now, they aren't able to raise. So they may have to look for to become a target. So I'm doing a lot of that work right now. And it's, the worst often I hear is like founders who be like, okay, I'll acquire, like, what do you want to give me for your business? But actually nobody knows your business like you know your business. So if you haven't first had a reflection as to what you think your value, your client list is, because you have, clients that are valuable. So if you have like L'Oreal or some of these big globals that are signed on master agreements over the years, like, can you transfer that? Can you transfer that into the acquirer? What are some of the great talent that you could transfer as well? So acqui-hires as well. So these are just checklists that I go through. We walk through the worst case. And then we definitely look at also extending. So in Canada, we have SHRED, IRAP, like all these government programs. Have you topped them up? Can you advance on those? So your 2021 has probably come in, but 2022, did you know that, many banks, Investment Quebec, RBC, Boast AI and or RBC can actually advance you the money on your SHRED to extend your runway. So all these things that founders are not thinking about because there's so much targeting to go fundraise that next round. It's just making sure to assess that reality and then move from there.
Yeah, and it's a bit of a sobering look here, but no one wants to start a photo sharing app or an NFT startup and not then be able to own a house. Like that's these are the stakes of play here, right? But again, we want to turn this to positive and proactive. So let's get Ethan in here from your perspective, because you've got, I guess, a slightly different checklist that you were referring to, which I really like, is the 4 stages of okay, which is a really good place to be in right now if you can be okay. So why don't you kind of walk us through that? And then we can pivot to the model that kind of Craft Ventures has pulled together in terms of efficient growth right now versus a different perspective on growth from 2021.
Yeah, absolutely. So look, I mean, just to go back to what we were saying earlier about the macro, right? The end result of all those things is that almost anyone could fundraise in 2021 or 2022. That's not entirely true, but like it was much easier to fundraise. However, that won't be the case in the this year and next year, and maybe even for 2.5 years. And so the question is like, where do you need to be as a business to survive during this tumultuous time? And so at Craft, we coined what we call the 4 states of okay. Basically, the 4 places it's okay to be as a business. Number 1 is cash flow positive. That one's obvious. You're generating cash. You can continue forever. Number 2 is default alive, which means that with the cash that you have on hand, assuming you continue to grow at your same rate, you can get to cash flow positive. So basically, that's what you're aiming for. Even if that's at a lower growth rate, then you would look for, if you're seeking venture funding, you don't need to be relying on venture funding, right? You're seeking towards being cash flow positive. Number 3 is default investable. And basically what this means is that your metrics are really good and you're going to be able to fundraise even in this environment. Now, that's what everyone wants to be, or what the vast majority of companies want to be, but most people aren't. And so we could talk in a second about what that looks like. But number 4, and I think this is really important, we call this the lean startup. Basically, if you're none of the first 3 things, if you're not cash flow positive or on your way there, or don't have super compelling metrics, you have to be in cockroach mode, meaning that you are super lean. You're not spending a lot of cash. You're giving yourself basically years of runway to iterate around your idea, to work with customers, to find product market fit, and then ultimately get to the point where you can either start to create a cash flowing business or a business with extremely good metrics. And I think like that's kind of the tough pill to swallow. There are some startups that were pretty high flying a couple years ago, but now are in kind of this no man's land where they're not on the path to being cash flow positive. They don't have ideal metrics. So what should they be doing? They need to cut back. They need to get lean, and they need to give themselves the time to ideate and to figure out what direction that they're going to go.
Yeah, I've always preferred cactus mode instead, where you're sucking in all available moisture and then producing dangerous thorns through which to defeat your enemies. But I think both kind of analogies make sense. So let's help people get to default investable here. Let's talk through from Craft Ventures perspective, how you're seeing what efficient growth looks like, and what can, whether it's right now or 3 to 6 months from now, as your operational team starts to turn things around, get your company into position to having phone calls and emails returned by your former lead VCs to maybe re-up for another round. Can we pull up Ethan's slide? Awesome. All right. So Ethan, again, I'm a liberal arts major, so this is all you, man. Talk us through this scenario.
Cool. So this is a framework we put together at Craft to present to our own portfolio companies, although I think it's broadly applicable. 2 quick caveats is like, number 1, Craft we're primarily Series A investors. And so, if you're significantly later or significantly earlier than that, these may not be completely applicable. Number 2, about 60% of our investments are in SaaS companies. So, these are kind of SaaS-focused metrics, but they certainly are more broadly applicable, and I'm happy to take any Q&A about how they apply to non-SaaS companies. But as a whole, look, if last year was all about growth at all costs, this year it's about growing efficiently. You still have to be growing fast to be a venture-backed startup. Indeed, it's almost critical. Let's say revenue multiples for private companies were 100x last year, and now we're down to 30x, even for very fast growing companies. if you're growing 3x a year, which is a great growth rate, you only need 1 year to grow into your inflated valuation from a year ago. If you're going 20% like the average public SaaS company, it's going to take you a decade. And so that's why like growth is like, especially in this time, like growth is so important. It always has been, but it continues to be. And that's how, you basically can earn maybe the healthy valuation you already got last year. But it's now not just growth that matters. It's being able to grow efficiently. It's basically having unit economics that you're not promising are going to work in the future, but that already work today. What this means is having high gross margins. For SaaS companies, they can be, hopefully at least 70%. It means having a customer base that's naturally expanding, so you don't have to sell new customers just to not have revenue shrink. We love to see, 140% net dollar retention for SaaS companies. Efficient payback. Most of the time when companies are spending too much money, they're spending too much money in sales and marketing. That's kind of like the death of all companies, because obviously you need acquisition to be successful, right? We just talked about how growth was, but if you're spending $1 to buy 50 cents, that's just not going to be a model that's gonna work long term. So measuring the efficiency of your sales and marketing team is super critical. And then if you have all those things, hopefully you'll have a good burn multiple. A burn multiple is basically a term that we coined at Craft, which is your burn in a period over the new ARR you generated. So basically, if I have to burn $1 to increase my ARR from $1, that's a really good ratio, right? Like as a VC, if I can give a company $1 and they're going to get $1 in ARR, and then that $1 is going to expand, to $1.40 within a year, that's a really good sustainable model worth building on. However, if you see that you're spending much more than that, if you're spending $2, $3, $4 for every new dollar in revenue you're getting, there's probably an efficiency issue like somewhere in your company. So this is kind of like the basic framework that we created to help companies think about how they grow, but in an efficient way that's going to attract capital in this cycle right now.
Okay, so how are Peter and Mozart doing? No, let's get actually Peter in on this, because, and I guess a question for both of you, because one of the things as you're talking me through that is like, so much of that seems to be the correlation between how much control you have over growth and the timeline of it, less than even it's overlapping what numbers you're trying to hit and in what window to set that up. And am I reading that properly? And then I just maybe throwing a Peter there as a follow-up after we get Ethan in. It just like, okay, so it's sales and marketing. Those are some obvious ones. What are some other core common issues, or again, so those inefficiencies that we might be looking to identify that companies aren't measuring?
Yeah. So, I mean, in terms of your question about timeline, look, you don't have to, Jason Lemkin has some great tweets about this, about like all his best companies, like 50% of their operating history, they were completely unfundable, right? Like your metrics aren't always going to be great. So what you're really thinking about is, okay, in the future, I need to fundraise, and I need to fundraise in a position of strength. And so that's why it's important, if you don't have these great numbers right now, it's important to be really frugal and to set yourself up to success so you can start investing and then see 6, 9, 12 months, of this really efficient growth going into a fundraise. Like that's what you're aiming for. In terms of common pitfalls, yeah, look, not measuring your fully loaded CAC, which I'll let Pete define, is a big one, right? You really have to understand all the inputs that are going to your sales and marketing engine. And same with that, you really have to understand all the things that are going into your cost of goods sold. If you have operations employees or significant customer support or customer success costs, or you store a ton of data for your customers, so your hosting costs are very high. You have to be really honest about these things to know what your actual gross margins are. The last thing you want to do is not be tracking these things and then get to a fundraise. And then when you're working together, with a VC on the numbers, realize that your margins aren't as good as you thought you were, kind of when you're in the midst of the fundraising. So it's good to get on top of these things and make sure they're in a good place now, and you're making sure that they stay good as you grow, so that when you do go to fundraise, you're doing so from a position of strength.
Okay. So Peter, there's a lot there. I think you can jump in on anything that resonates most, because we're also going to be walking through the way that kind of Katy and Real is seeing this as well. So how much how much do you believe what Ethan's saying right now? Or which of his numbers do you like the most when Mozart's looking at this from your perspective?
Well, Ethan, as an investor in Mozart, I sort of almost have to believe him. I'll
Great
first
answer.
say that. I'll first say the most important thing was almost like the title of the slide, that times have changed from growth to efficient growth. And to complement both Ethan and Katy, they're here because they're still on the dance floor. They're still making investments. They are basically even telling you what is their standard for making an investment. I think across the board, the standard has changed from growth, which is sort of almost very easy to grok. It's one metric. It's typically revenue or some variant of it, and basically the change in revenue over time. Now, when Ethan puts up a slide, he's talking about things like efficient growth, and in efficient growth, you start using terms like CAC and burn multiple and payback period. These aren't that this isn't like some advanced math class. These are pretty simple metrics, but they typically involve a numerator and a denominator, or two different metrics. And when you do that, you start finding that these metrics don't come from the same place. They typically come from multiple places. You typically have a source of truth for your revenue. For a lot of B2B companies, it's a tool like Salesforce or their CRM, and maybe it's like how the sales team will enter it. Sometimes it's something like Stripe. If you're receiving your payments that way, you have a source of truth for what's coming in. And then you also have a source of truth for what's going out. Typically, when you're investing in an ads channel, they send you a bill at typically the end of the month or in real time. And your bank account is your reality. So typically, what we see is that a lot of companies are needing to combine these metrics now. Now, a lot of what we've talked about is to sort of satisfy the ability to be fundable. So not every company, I think everybody on this panel has mentioned there's a lot of heterogeneity. That some companies are at the stage of they're looking for funding. Maybe it's their first check. Some companies are at the stage of they've been funded and their runway is running short and they need additional funding. And of the states of okay, state 4 is to go into cockroach mode, and state 2 and 1 is ideal, but state 3 is really achieve great metrics. So knowing where you are in terms of achieving great metrics sort of speaks to how fundable you are or your need to go into cockroach mode. But the one thing that I would call out about sort of Ethan's pitch is that it involves metrics that are more sophisticated than just grow. And I think, as Ethan points out, we don't expect to see that for 6 months, a year, 2 years, or maybe ever. So I think that what we're seeing is companies really needing to capture more data in order to really know where they are on that scale and adjust for fundraising sake. But then also for operating sake, these metrics aren't there just to sort of appease funders. These are metrics that help guide how you should operate. They're there because it signals to funders you've got a great business.
Yeah. And they're, to your point, I think, to say it explicitly, those are metrics that need to be managed, both in terms of making sure you're collecting them, but responding to them in real time to make sure that you're achieving them and hitting that kind of proper window, a position of strength that Ethan was speaking to. We got to get Katy in here. She's also on the dance floor, but then also like you're using a slightly different rubric to judge this. And oh, go ahead.
Before I get into the rubric, actually, I just want to comment on what's been said. So I just we invest in larger than just SaaS companies. So like, I think what we've discussed a lot, it has been very specific to SaaS, but when it comes to like life sciences, med tech, health tech, quantum, deep tech, any kind of, none of this necessarily applies in the same way. So, some of them that need, we have a couple of companies that are in the med tech space that need, Health Canada FDA approval. Like the cycle times, like you're not going to get your ARR, and you're going to get so a lot of that's going to be in R&D and the patents, and so you have to be very I'll get into our kind of what I refer to as a metric, but it really depends on the type of business that you're in. So if you're in a hardware software mix. So you're actually deploying hardware, and you also have the software on the platform on there. If you're a marketplace, some parts of this will be different as well. So just for a broader look at for the listeners out here, what we're talking about is it's probably more SaaS oriented. So software as a service type or service industry related. But that's necessarily not the Bible for depending on what type of business that you're doing.
That's such a great point, and I'm so glad you brought it up, because I think typical Canadian, I went default SaaS business in my mentality here, right? Because that's what Canadians generally like to build. But if you if you are building a business measuring yourself against kind of like the wrong numbers or the wrong numbers for the type of business you're being, even if you achieve them, you're not setting yourself up for success. So I'm so glad you made.
I would say. In Canada, based because of CFAR funding so much research, we actually have a lot of amazing, it's not because AI hit in 2016, 17, and all of a sudden, Canada become this epicenter. CFAR, Canadian Institute for Advanced Research, has been funding research labs since the 70s. Like quantum, which is like the next thing coming, that's been being funded since the 90s. So some of these, Institut Quantique in Sherbrooke, or like Perimeter or Pickle in Waterloo, these have been incubating this stuff that's now, coming out. But the time horizons and the metrics on that is, the quantum computer is not going to, I don't even know when that will transpire. But, you have companies going public, you have companies raising significant rounds based on the science behind there and advancing. So those are completely different metrics. And I think in Canada, we have a lot of businesses and you see the BDC with all the different funds that they have that are funding different time horizons. Some of the health tech funds have 12-year fund cycles instead of 10-year fund cycles. So it's really interesting, I think, in the Canadian ecosystem to see how different funds are set up to support different metrics and different businesses depending on what kind of startup is being built.
Well, and you already mentioned Shred credit return for R&D as well, which is something that our friends in SF can't generally take advantage of, right? So, which have been a huge proponent for Canadian companies. So, those can shift kind of your target goalpost. So I'm glad you're bringing all this up. The reason why I think we also wanted to show, you just said something that was very VC and very fun and very honest that I really appreciated, is that sometimes you just go back to founders and be present your numbers in this format so I can evaluate where you're at. And that seems,
that's what I do.
It seems very harsh, but I will say, as a founder myself, I'm very much, thank you for ordering the structure so that I can see and communicate back and forth on this. So why don't you kind of walk us through your dance card here?
So the dance card is not mine. This is actually the Bessemer Ventures, which I found someone, actually, if you can believe it, a founder presented this to me and actually put his numbers down the line last year as I was making an investment. And I was so impressed. I actually included it in my investment memo. And since then, I've been using this as the go-to post. So definitely a hat tip over to Brad at Halio, who raised this week, actually. So the thing is, this is Bessemer kind of scoured their 200 plus investments in cloud SaaS, and these numbers are actually from their investments and their portfolio, which I think is really great. So for those who don't know, I actually ran data analytics for many years at the casinos. So data is very true to me as well. And this all you have to do is Google, scaling to 100 million on Bessemer, and they literally have a lesson 1, lesson 2. They explain every single one of these metrics, like what is ARR, why is that important, what's net retention, why is gross retention. So a lot of the numbers that Ethan presented are actually spot on to these in the 1 to 10 million. So he talked about the net retention at 140. This is gross margin at 70. So basically, it's like a roadmap to say, as a SaaS cloud company, when you're making $1 to $10 million in revenues, this is what a ballpark should look like.
Yep.
And when you move from 10 to 25, some metrics will slow down, like because you're dealing with a lot bigger volume. If you 10x your bake sale versus 1x
Yeah.
a really big company, it's not the same thing. So this is kind of the grid, and I refer to this quite often. The R&D efficiency. So I think Ethan and Peter mentioned, sales and marketing expense. Like this is the efficiency, the CAC payback. So actually, this I've been using since since last year. So I was probably one of the poo-poos in the last the last year or so. Like I was still talking these. Like I still want to know what your CAC and I want to know what your payback is. And I required this of all of my companies, whether or not they wanted to give it to me. So I was definitely counter current last year. Asking for all this stuff. But I think it's come full circle, and it's super important because, to Peter's point, these are basic metrics. These are not just what to do to please your investor. These are actually what good businesses do. And at the end of the day, you can be on the VC treadmill or the non-dilutive treadmill, but we're funding to build a solid business, and that's what these metrics are for.
Yeah, well, and hey, you might have been pushing against the grain and kind of forcing that of your portfolio companies last year, but there was no it was no surprise to us that when Bessemer came out earlier this year talking about 100 million ARR, being a centaur, essentially being a much better milestone than a unicorn, because there's a lot of unicorn companies suffering right now, that we saw Canadian tech companies like Clio and others being like, actually, we are a centaur. We have hit that milestone. We are okay. We are much better within the current health framework. So I think that's entirely valid. But I'll go, Ethan, we're seeing some connectivity here. Like Katie made the point previously about the differences between SaaS business, deep tech, health tech. The way that Bessemer is laying it out by stage, is there anything that you're seeing there at some of the later stages that you play at invest in where you're like, that's exactly true, or you'd like to see something different or something to keep in mind there?
No, I mean, look, I think the Bessemer framework is helpful. I mean, definitely, we occasionally do some growth stage investing, although it typically tends to be kind of in the late venture period, more Series B, occasionally Series C. And, look, it really is the same thing. I mean, I think just the kind of the theme that we've been saying all along is these are really like fundamental numbers, and they're fundamental numbers that maybe didn't get the attention that they deserved the last couple of years, but it really is about like, look, are we building an efficient business? Can we, successfully, can we efficiently acquire customers who are going to produce revenue at a margin that helps us, cover the cost of servicing them and cover the cost of acquiring them, and then move towards being a profitable business over time. So it's really consistent. And look, and that's not just for SaaS business as well. It's the same concept. For all types of businesses. We invest in a lot of marketplaces. Jeff Fleur, one of the general partners at Craft Ventures, was the founder of StubHub. So he built a marketplace, during the .com crash, and is very familiar with both downturns and what it takes to create a marketplace. And we have we have our own set of like benchmarks for those, but it's frankly really the same thing. It's can you acquire, typically it's about acquiring the demand side of the marketplace. That's what's most important. Can you acquire them at a cost which once you take basically your gross profit from that customer, so once you take out all your contra revenue items that kind of go to the market, that go to the supply side and all your cost of servicing, when you take that gross profit thing, how does that compare with the cost to acquire the demand? And it's the same CAC payback framework as with SaaS businesses. So it's really remarkably similar, even though you have to move some of the numbers around a little bit. And we actually also recently published a piece about how to do burn multiple for a marketplace business while accounting for seasonality and things like this. So there are some shifts that you have to make, some transformations, some might say, that Pete can talk to. But it's really like the same concept. These are just like the fundamental business concepts of making your unit economics work, and they can be applied to certainly any software business. And if you do so, if you really stay focused on those, you're going to be setting yourself up for success.
Yeah, and if anyone's furiously Googling like Bessemer Ventures right now, we will drop the links in the chat for this, and we will include the kind of reference information in our wrap up on BetaKit. So if you're stressing to search for this stuff, it will not disappear. This conversation will live on. But kind of before, like somehow we've been talking for 50 minutes here. I think and we're sticking on the most important point. Before we go to kind of like our final segment, I want to allow Peter to jump in here and see if this resonates with you, because you were talking about, and I think everyone agreed, some of these numbers or the analysis, the metrics are generally really simple, and it's more about the collection. I'm wondering if, when we were throwing up the Bessemer slide where we're talking about how these numbers align at later stages, is there any additional complexity there in terms of the data capture or anything around actually analyzing at the later stages of the higher numbers? Like Katie made a great point of like, yes, we have 10x our bake sale versus like, is there anything that you see as companies move up and play maybe in a larger fish tank with more competition or greater maturity or complexity in their sales funnel or R&D spend or things like that, where you would be advising some maybe hidden speed bumps or how to integrate and analyze that data?
Yeah. So I think the first thing I'd say is I'm really glad that we've sort of all aligned around, I think what healthy approximately looks like and what companies are trying to achieve or need to achieve in this environment. We have an internal company core value called Satya. My partner's a yogi, so it's truth. And I think a lot of these metrics are there because they're very sort of informative of what a healthy company looks like. But even those metrics themselves have biases. Ethan mentioned one around seasonality. One of the ones that you see typically in early stage companies as they sort of mature is that a lot of the early stage revenue gets generated off of friends or friends of friends or friends of friends of friends, sort of very warm, cold intros. So, and I think one of the things that I would really encourage companies to do is, yes, create these metrics and hold themselves accountable to it, but sort of be aware of what is the truth of these metrics. How repeatable are they? The point of the metric is that what you've achieved in the past is very predictable of what you'll achieve in the future. And sometimes that's right, and sometimes that's less right. So I think the typical thing that companies struggle with as they mature is basically how repeatable of a process have they introduced.
Okay, and that's an important point because in full disclosure, the numbers for our stream are slightly higher than they normally would be because Katie's dad is currently watching the stream. So hey, hi to Katie's dad. Thank you for joining us. Hopefully that'll be repeatable on future streams from which we have her. But maybe like this is a great transition into I love truth as a framing for our third kind of segment, which we're going to have to burn through a little bit. And if you're willing, stay on a little bit longer. This idea of like having tough conversations. And I love that framing the idea around the idea of truth because, and I'm going to go right back to you, Peter, with this, and then we'll let the kind of VCs come in because they have tough conversations with founders, but it's people like you who have to like implement the tough conversation in your business. And I'm wondering how much of the truth component is, are we able to measure truth? Are we able to balance the bias versus are we able to like be honest with ourselves about what the numbers are showing us? And that is informed by data, but businesses are run by people. Founders are human. Their employees are human. I'm just wondering how you level set with that personally as someone who deals with data in all aspects of your business.
Yeah, and this is actually going back to the last question, something that gets easier with size. So when we were a smaller company, making one sale a month would be tremendous, and and if we wanted to grow our sales 10% month over month, that meant 1.1 sales. And in reality, you don't make 1.1 sales. You make 1 or 2 or 0 or whatever that number is. So I think one of the hard things for a lot of companies, either at the pre-revenue stage or at the really small amounts of revenue stage, is that the N is small. That the sort of the percentage growth is a little bit difficult, to fully grasp. It's like, oh my God, we went from 1 to 2 sales. Oh, we're growing 200, 100% month over month. So, if these trends continue, we'll be the size of, Apple in a year. And I
We've
think
converted 50% of all parents watching this stream. It's like we're
nice.
just totally attacking that
That
market.
is, yeah, I think I think that these things are all tied together, which is you want data to be sort of at the core and base of what you do, and there's certainly truth in data, but there's also a lot of lies and statistics, right? So I think that it's very important as the operator that you sort of sift those things apart, and part of it is just simply measuring these things will help in sort of getting towards a truth, but that's not sort of where it has to end. And then in terms of your interpretation, be aware of your bias. I mean, you as the operator really want this channel to work out. You really want this team member to work out. It's difficult to shut down a channel or let
Kill a
go of
product
someone
feature. Yeah.
all of these things are or pivot your product to have a new feature. All of these things are hard. People have a strong sense of sort of inertia, and I think if the best companies are going to be the ones that are sort of, I would say, most aware, and I think that that's kind of the challenge of don't. I think the point of this conversation was this is the data that you should be collecting, that you should be looking at, but it really just doesn't stop right there.
Yeah. Okay. That's awesome. Kate, I want to get your perspective on this because I just know that in the Canadian tech context, you're having a lot of tough conversations with founders right now dealing with this. And I'm wondering how you get them to kind of get to the point, the evolved place that Peter is at, or kind of push through their inherent optimism or maybe willingness to bet. Because you have to be absolutely fucking nuts, let's not mince words here, to build a business and to see past the struggles. And sometimes calibrating that back to what the data is telling you is really difficult. How do you break through beyond the numbers to your founders and connect with them in a way that I think most VCs hope that they can?
I think Peter's point, I will just put a word to what he was describing, which is like a lot of ego. I think, products that you're stuck to, people that you're stuck to, because you put a lot of time. You call it inertia. I would also label it as like, but that's the thing I've been building, or the people that I've been hiring, or the blah, 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 blah. And like at the end of the day, it's like you don't want to let go of your own sandwich, and that's really difficult. And I think getting people to see, I love that expression, strong opinions loosely held, and it's about, making sure that you have strong opinions, but they're loosely held. They're based on facts. You're able to have a rational conversation. And I think for me, it's all about asking the questions. And I invite founders to ask, be honest. I think Peter said earlier, like, how can you be honest with yourself and as an executive team and with your board? Like, are they saying things to you that make you feel uncomfortable? And then you want to disagree, or is the discomfort something you should sit with, and maybe that discomfort is actually wisdom hidden in a way that it feels aggressive to you because your ego is involved in that at that point in time. So a little bit meta what I'm saying, but it's really like that resistance. Where is the origin of it coming from? And then, and the hire slowly, fire fast. Like, I think we often startups, we don't cut our burn fast enough, and, one of my founders, I'll have to hat tip to him. Like he was in the process of an acquisition and he presented to the board. He slashed half the staff. He moved his office from where he was into like this co-working space. And we were in the middle of an acquisition. And I said, well, what are you doing? And he goes, and this is a seasoned founder, and this is like probably in January before all this. And he goes, 90% of LOIs never actually turn into an acquisition. I better like set my ship straight now, because if that falls through, then I'm up Schitt's Creek without a paddle, and I'm not prepared for that. And I think that, those founders that I find have that kind of attitude, I'm pairing with younger founders. So if I can't get through to them, don't listen to me. Here, let me put someone that's been in that seat and has made that tough call and had that tough discussion. And I don't need to be there. But, I think that credibility between founders is something very, very powerful, which, when we have large portfolios, like, at Rio, across the 5 funds, we have over 200 plus portfolio companies with brilliant people working that have seen the ups and downs. How do you pair that so that, when I'm delivering that tough message, don't listen to me. Here's my opinion. Throw it in the garbage if you don't think that it fits with you, no problems. Here's like a plethora of other opinions. Please go seek out. Like I'm a focus group of one. I've got one slither of the view. Go get the other views. If you don't agree with me, and then come back and let's have that conversation.
Yeah, and hey, let's to your credit, let's also talk about alumni networks for incubators and accelerators. Founder Fuel's a real component of that. We just published Aaron Burry, CEO of a Founder Fuel company, Willful, who was receiving so many requests in her network about advice on how to go on maternity leave as a founder that she was like, I'm just going to write this up and publish it on BetaKit because it'll be easier to distribute. So like that's a huge component of it. Okay, so we've got lies, damn lies, and statistics, strong opinions loosely held. Ethan, you got to close this out with your go-to quote here, and maybe towards that optimistic bent. I'm not to push you there. Let it be natural. But what's your kind of internal mantra for this type of stuff?
Yeah. I think, look, it'd be two things. Like the first thing you talked about, getting through to founders, right? Like conversations can be tough, but ultimately founders are in it for the right reasons, almost by definition, right? Like they want their companies to succeed. And, what's going on in the market may be out of their control. It may not be fair. You could say that it's hypocritical that VCs were wheeling and dealing and investing irresponsibly, but, it's not like you were turning around to be vindictive. It's about, what's in the best interest of the company, and what's in the best interest of the company is surviving. That's what I think is important for founders to understand, right? Like you're doing these things to give your startup the best chance of being successful. The good news, and there really is good news, is that if you are responsible, if you are diligent, if you are laser focused on your numbers and efficiency during this period, it can be a great time to build. Innovation doesn't stop in a downturn. On the contrary,
there we go. There's yours. That's the mantra right there. That's the winner.
That's an important one. Shout out to David Sachs. Sorry, I lost my train of thought. So innovation's up in a downturn, and actually, on the contrary, everything besides fundraising gets easier. Right? Yeah, it's going to be harder for you to fundraise, but you know what? It's going to be harder for your competitors to fundraise, and it's going to be harder for new competitors to, get their initial funding and come to the market. So this is a chance where just by being more disciplined and by out executing your competition, you can gain a leg up on them. It also can be easier to recruit. There's fewer other startups out there giving offers to the engineers. Engineers who are at big tech companies just saw the value of their stock-based compensation go down significantly. These are all things that are in your favor as you're hiring. So there are, and there's less distraction, frankly. Sometimes you're in the hype cycle, like you're constantly getting hit up by VCs and going to this conference and that conference and talking to this reporter and that reporter and speaking at this event and that event. And all these are good things, but there's just so much going on that's not you building your business, right? Like that's not you sitting with your engineers and sitting with your sales team and thinking about what do we need, and talking to your customers and be like, what do we need to do? What do we need to build, to make our customers more successful, to make us more successful. And there's a lot more focus to do that. So, I think if you can get your numbers in line, if you can be diligent, if you can be responsible, if you can figure out, what your plan is and what's going to work for your business, this could be a really great time to build an enduring company.
Okay, so we're talking focus here. We're talking kind of clarity of thought and vision, having the visibility through clear metrics and data. All of this is wrapping up into a nice, neat little package. We did not plan that at all, but we did plan on having some really good guests to have this conversation. We've now gone 5 minutes over our planned schedule. I told them before we started, hey, we'll probably go 45 minutes organic into the conversation. That'll be fine. We could probably talk for another 20 or 30. We're going to cut it here. We're not going to any viewer questions here. That's a little bit of irregular for us, but don't worry, because post those questions on Facebook, post those questions on Twitter. We will get them asked and answered by our panelists for the wrap up that we publish on BetaKit. No one left behind here. We will share all the reference links to the data, because again, this this is just one moment in time, and there's going to be more moments, and you want to make sure that you're prepared for that moment where you have the leverage, and that requires work. So I hope some of the information and context we provided today has been helpful to you for your business, because trust me, media startup right here, we're all feeling it, but we all have that opportunity. So on behalf of BetaKit, on behalf of our panelists, thank you so much. This has been awesome. I kind of want to keep this conversation going. We will have future conversations. Thank you so much. We will see you at the next BetaKit Live. I'm Douglas Saltis. BetaKit out.